Welcome options traders, happy Friday everyone. And I wanted to post a video here, especially for all of the new traders, to talk about some of the specifics with rolling. It's probably the most important topic and concept you can learn as a new options trader. And I've touched on rolling in previous videos, different aspects of it, but I don't believe I've ever put them all into one video where I've talked about how, when, and why we roll, and then also show you how to do it in your broker's platform. So let's take a look at all of the ins and outs of rolling. So first of all, what is rolling? Well, rolling allows traders to switch from one contract to another. That's probably the simplest definition. And what we're trying to do here for this video is to roll up with our calls or to roll down with the puts. And the reason we're going to do that is that it allows you to reduce your risk, the amount that you have paid for these options, but still hold out for bigger returns. And that's important because if you don't do that, especially when you're new, you're going to buy this option for $5. It's going to go up a little bit. You're going to get scared and you're going to sell it only to watch the stock take off like wildfire and really have potentially given you some big returns, and you're going to miss them. So how do we solve the puzzle? Well, rolling is it. Now there's lots of types of rolling we can do. We can roll up and down, we can roll out, we can roll in, up and out, down and in, and there's different reasons that we do it. But for this video, we're just going to focus on rolling your calls up and rolling your puts down. These are the two keys, especially when you're new. So let's take a look at an example. Let's say that you buy a $50 call and the stock moves higher. It's moved in your favor. How much higher? Well, hold that thought and we'll talk about that in just a minute. But for right now, just assume that the stock has moved sufficiently high enough to where it's time to roll. What are we going to do? How do we do it? Well, we simply sell the $50 call and we buy the 55. And if you look at those two trades right there, selling the 50 and buying the 55, that is mathematically another type of a strategy called a vertical spread. And specifically, we are selling the 50-55 vertical spread. So that's just how easy it's going to be to put into your broker's platform, to roll this call option up. Sell the 50-55 vertical spread, you're done. And when you do this trade, it's always going to generate a credit. Why? Well, there's another principle in options pricing that says that lower strike call options have to be worth more money than higher strikes, assuming we've got the same expiration. So when you're selling your $50 call, you're going to receive more money than you're going to spend for that 55. And that's what's going to help to reduce the amount that you have into the trade, or what we might call the risk. Now, sometimes new traders look at this and they say, hey, wait a minute, if I bought the $50 call and then I turn around and sell a 50-55 vertical spread, don't I have two positions in my account now? Well, it looks like you will, but the trick is that when we sell this 50 call, that's going to be a closing transaction, and when we buy the 55, it's going to be opening. And so those $50 calls are going to cancel out. So here's what it's going to look like. Here's your long $50 call that you initially bought, and when the time is right, we're going to sell the 50-55 vertical spread, which are just these two trades right here. But notice when you do that this long $50 call right here gets canceled by this short $50 call. So when that trade is executed, you're just left with a $55 call. So you've rolled up from the 50 strike to the 55. You still have unlimited gains, but you've sharply reduced the risk. So we'll look at some more examples in a moment, but let's talk about when to roll. Well, there's a basic idea here, is that you should roll if the short vertical is trading for about 80% of the difference in strikes. What does that mean? Well, it's actually quite easy. Well, in this example, we were looking to roll from the 50 to the 55. So notice that that 50-55 vertical has a $5 difference in the strikes. If you take 80% of that $5 difference, that's 4. So it's quite simple. If the 50-55 vertical spread is trading for 4 or higher, place a trade. It's just that simple. And in fact, we can even automate it, and I'll show you how to do that in just a moment. So what is this going to do for us? Well, here's what it looks like graphically. Here's your long $50 call in red, and we can make an unlimited gain up here, and yeah, we've got limited risk of 6. But that doesn't mean we'd like to watch this $6 go down the tubes. So how can we stay in it but kind of manage this risk? Well, if I'm going to roll from the 50 to the 55, all I have to do is keep my eye on the 50-55 vertical spread. So I look at my broker's platform and let's say that it's trading for 275. Rule says we need it to be trading for 4 or higher. It's not ready to roll. I look sometime later, it's trading for 3. Not ready to roll. Sometime later, 375. Not ready to roll. And then one day I look at it, the stock has moved to a point where the 50-55 is trading for 4 or higher. That's our green light. So I'm going to simply place a trade to sell the 50-55 vertical spread. And what that's going to do is it's going to move me from this red line to this in blue. Why? Because I've received a $4 credit. I initially had $6 into the trade. I now put $4 into my pocket. So now the most I could ever lose is 2. But notice that I still have unlimited potential gains up here. I didn't let that go, but I've just sharply reduced the risk. So this is the reason for the roll. The primary reason is to shift this maximum loss portion higher. We're just reducing that risk, and yet we still have unlimited potential gains. Now, if we get a chance to roll it again from the 55 to the 60, which I'm going to do the same series of steps. If the 55-60 spread is trading for a credit of 4, do it. And then I would have rolled from the 55 call to the 60, and I have therefore gone from the blue curve to the green. Now this is when things get really good, because notice that my green curve sits completely above 0 over here. I can't lose. I have a guaranteed gain of 2, which is shown by this area down here. No matter where the stock price might fall below 60, the worst that can happen is I made a $2 profit on my $6 investment, or a 33% return. That's the worst that can happen. But look over here, I still have unlimited gains. So again, notice that what I'm doing is I'm shifting that profit and loss curve from the red to the blue to the green, and I just keep walking along with that stock higher and higher. Now you get a similar thing with put options, but remember you're going to roll your put options down. And the reason we do that is that put options make money as the stock price falls. And pricing principle for options says that higher strike puts have to be worth more. So let's say if we're long the $60 put and I roll down to the 55, I'm going to put money in my pocket. So again, let's say that we start with the $60 put, the 55-60 vertical put spread is now trading for 4. Sell it. And that means I'm going to sell the 60 put and buy the 55. Those cancel, and I'm now long the 55 put. Notice that I used to have the 60 strike, and I've now moved down to the 55. That's why it's called a roll down. And I'm just going to keep doing this as that stock price falls. And this is what we're going to do from a profit and loss standpoint. So in this example, we started on the red curve here. This bend is the strike price, and then we paid $6 for it. And if we roll for a $4 credit, I move to the blue. Now I've only got $2 into the trade, and I've got the 55 strike. Stock moves down some more. I sell the 50-55 vertical. I move from the blue to the green, and I just keep moving up. So once again, the primary reason for doing these rolls is we want to shift these curves higher, and preferably above 0. And once you've done that, the fear is gone. Now we can really let that thing run. And in fact, there's a whole nother world of strategies we can do to make it even better. But let's start with the simple ones. Well, now that you understand the basics of rolling, let's go over to a broker's platform, to our ETrade platform here, and see just how easy it is. So here we are into the ETrade platform, and most brokerage platforms work in a similar way. If they're worth anything at all for options trading, they will allow you to trade according to strategy. So for ETrade, I can do that right up here. If I want to trade a vertical, I can trade it right there. These are the individual calls and puts. So let's just do an example. Let's say I'm looking at the March 20s, 42 days to expiration. And for whatever reason, I've decided I want to buy this 150 call. So over here, trading for almost 7, pretty close to the example we were using at 6. And I'm going to click on the asking price. And I would typically use a limit order, but just for the video, I'm going to go at market just so we get it filled. So we're buying one contract Click on preview and we send it away. And now this is going to get filled almost immediately. And you can see right there, we are filled. Now, at some time, I would like to roll this. And what I'm going to look for is if I can sell the 150 and buy the 155 for a credit of 4, I'm going to do it. Now, you can kind of do a shortcut way without looking at your vertical spreads just right here. I can see that right now I can sell my 150 for $675 on the bid, and I can pay $385 for the 155. So this isn't even close to the $4 that we need. But does this mean I need to just sit here every single day and watch it? No, let the computer do it for you. So watch this. Let's come up here to calls and puts. I'm going to change it to vertical. I want to sell the 150, 155, and you can see right now the natural is pretty close to what we just saw, $3. I want to sell it for 4. So let's click on the bid, and right here we are selling the 150 call and we are buying the 155. Now the natural again is 3, but I want 4. How do I do it? Just place this at a $4 limit. Let's make it good till canceled. And then I'm just going to let the computer trade it for me. So watch what happens when I choose preview. See, the computer knows that that's a closing trade. You can't be long and short the same contract in the same account. So this has to be a closing trade. So if this order right here ever fills, I'm just going to be long the 155 call. I've in fact rolled it up. So all I have to do is click send, and that's just going to sit and cook until the day ever comes. If it ever trades, and if it does, it'll just automatically do it for us. But for right now, it's just going to remain in open status. What about the puts? Same idea for the puts. Let's say we bought the 150 put and I want to roll it down to the 145. Well, I'm going to be selling the 145, 150 vertical spread. Click on the bid. I'm going to be selling my 150. I want to buy the 145. I want to do it for a $4 credit, good till canceled. Preview it. Now notice in this case, they are both showing opening trades because I don't actually have the 150 put in here. But if I did, this would show a closing trade. But the idea is that it's just that simple to place the trade for a vertical spread, and that's how easy it is to roll. So hopefully you see how easy it is, but I want you to see even the bigger picture of why it's so important. And for those who'd like to learn more about the art and science of options trading, please check out the Alpha Trader course and strategy lab at optionsatoz.com. Also, please join us on the Facebook trading group Options A to Z, and you can find a link in the description below.